I've heard now from a few sources that the Canadian banks and the banking regulators are considering putting some industry-wide mortgage rule changes, including increasing the minimum down payment required up to 35% for investment properties and to restrict the use of a home equity line of credit as the source of a down payment. If you're new to my channel, my name is Koukun and I'm a real estate investor, and I run a real estate team here in the Niagara region that helps investors buy and sell rental properties. If you're interested in learning more about what we do, check out the link in the comments below to get our free beginner's guide to creating a legal basement apartment. All right, before we dig into the rule changes, I'm going to first give you a few statistics to give you a better sense of what's been happening in the real estate market, especially here in the Niagara region. And let's focus on the city of Welland, where we've helped quite a few investors buy and sell their rental properties. When I first got my real estate license, it was around February of 2016, the average median sale price of a home in Welland was $215,000. And in 2017, when I was actually moving to the Niagara region from Mississauga, the average median sale price had increased to $260,000. In February of 2018, just a few months after I had quit my previous job and became a full-time realtor, the average sale price further increased to $298,000. In February of 2019, as interest rates rose close to 4% for the variable rate mortgage, the average sale price in Welland increased to $325,000. In February of 2020, this was just before COVID started, the market was on fire and the average sale price further increased to $410,000. February of 2021, this was when COVID was in full swing and we were just getting news of the vaccines, the average sale price increased to $527,000. And right now in February of 2022, 2 years after COVID started, after the Omicron wave has run its course and now things are really starting to open up, the average sale price has increased to $710,000. This is over a 3 times increase from 2016, just 6 years ago. And at the same time, in the past 10 years, we have seen purchases of secondary homes. So that includes real estate investors, people buying cottages, and even people buying a second home. But most of it, I would say, is sort of the investors, and maybe a partial chunk of that is the cottage buyers. We've seen that portion of home buyers increase from 15% of the overall sales volume up to close to 25%. Keep in mind that has been close to the 22% mark since 2017. So it has increased since COVID started, but not as dramatically as most of the media would want you to think, but it is still at all-time highs in terms of the percentage of the sales volume from investors and second home buyers. So with these proposed rule changes, the government is proposing to increase the required down payment on those 25% of home buyers who are buying a secondary residence, and it may even be restricted further to just real estate investors. We'll have to see. It's still unofficial, so we don't really have clarity on the exact details on this. But let's discuss the impact of what some of these changes may include. The first change, I suspect, is that the number of investor buyers will definitely reduce. We are looking at close to doubling the minimum down payment required for an investor to purchase a rental property. So it is very likely that the 25% of secondary home buyers may significantly reduce. Second, we may see more of what we're already seeing, which is investors partnering up together to purchase an investment property together. So far, we've seen it more on the mortgage qualifying side, where it's become harder and harder to qualify for mortgages as prices have continued to rise. But this may shift to partnerships simply based on not having enough money to put down on a rental property, where previously, if you had 20%, that was sufficient. Now, 2 of those investors who have 20% of the purchase price may combine their funds to buy a property together. 3, we will actually start to see an increase in the monthly cash flow from the investment properties that investors buy after these rule changes, because with a 35% down payment, your mortgage payment is significantly reduced, as it's only 65% of the value of the home, and therefore your cash flow numbers are significantly higher. Number 4, with the real estate resale market, we may see the market plateau, even have a small correction because of the number of buyers in the market reduce. This may not be long-lived because there are still significant supply shortages of housing, and we do have quite a bit of immigration into the Ontario and Greater Toronto area. So while a reduction in demand may reduce demand and prices in the short term, it is not something that I'm expecting to last for a long period of time or to be sustained. Number 5, reduced speculation. I think this is actually a good thing for the real estate market. Right now, we are seeing a lot more investors speculate and buy properties simply with the hope that it will go up the following year, that they can sell it at a profit. With a 35% down payment requirement, it may become quite a bit harder to do something like that, and therefore may incentivize more long-term investors who are choosing to buy and hold the property versus someone who's looking to be in and out in a short period of time, hoping to make money because the values continue to rise. Number 6, the rental market. Unfortunately, I believe one of the results of these rule changes will probably mean that the rental market will become even tighter than it is now, because less investors will be able to buy rental properties, will be able to create rental units, and we may see more transactions where a landlord sells a property, but it is bought by someone who's going to move into one or more of the units, therefore removing supply from the rental market. And number 7, counteracting some of the previous points that I've made here, one thing we may start to see is an increase in the use of secondary financing or private financing, because a private lender will very easily lend up to 80% of a purchase price at a higher interest rate versus a traditional bank. After these changes may only go up to 65%. So that remaining 15% may be funded by private lenders charging 6, 7, 8, maybe even 15% interest, depending on the creditworthiness of the borrower. And this may have a detrimental effect by increasing the leverage that investors take on to buy rental properties, reducing their cash flow, and maybe put them in an over-leveraged situation, which is not ideal. Number 8, home equity line of credits for down payments. I don't think this rule change to restrict the use of a home equity line of credit will make a huge impact, because already some banks don't allow you to do this, and the simple workaround is that instead of having a line of credit, you refinance the house, increasing the mortgage on the subject property to pull the money out, and then you use that money as a down payment on the rental purchase, and therefore there's no home equity line of credit used in the process. So I think that change may not be as significant on the investment side. But another proposed rule change with that home equity line of credit is that they may not allow you to go up to 80% with the combination of a home equity line of credit plus your mortgage, and may restrict it to be a total of 65% whether you have one or both. This makes an interesting situation where less homeowners may have access to a home equity line of credit, which may actually be good to reduce the amount of personal debt that people take on for personal consumption, because a lot of people have been using their lines of credit to buy boats, trailers, and just different personal expenses that they've been wanting to borrow at very cheap rates. So this may reduce that, which may overall reduce consumption in society, but I think it's a good thing to do such a change to reduce the amount of personal debt that people take on. All right, final thoughts. I think this rule change is probably for the best, given how crazy the market has been over the last few years. It would be good to put some measures like this to reduce speculation and encourage more longer-term real estate investing. Unfortunately, I don't think it's going to solve the housing shortage that we have in Ontario, and it may even make it worse, especially on the rental market. For those investors who have 35% to put down on a property, I think it will open up opportunities to maybe get properties at better prices, and if not, at least with much better cash flow, since your mortgage amount is significantly less. I hope you found this video helpful. Again, these are just my opinions on what would potentially happen if these rule changes do take place. And again, there's no guarantee of it coming to place quite yet, but we'll just have to watch and see in the coming months as things unfold. And yeah, again, if you're interested in contacting us to work with us, definitely check out our beginner's guide to creating a legal basement apartment in the comments below. Until next time, all the best.